But why not tackle the global bit, which is, I think, best addressed with a veteran. Adrian Mowat is with us, investor at Hong Kong SAR. He's joining in, someone who's seen these cycles and markets for a long time. Adrian, great to have you with us here. Thanks very much for your time. Happy New Year. We're talking for the first time in the new one. How are things looking, Adrian? Is there January seasonally, at least here in India, and we looked at data going back the last decade and a half, is weaker. And we've never had an instance when November and December have been so strong as they were in 23, and you had a strong sort of January the next year. So there is seasonality perhaps which is working against us. But otherwise, how is the price action and fundamentals looking?
So, I think it's reasonable that markets are having a bit of a breather, consolidating. So you're not getting any clear trend in looking at the day-to-day movements in markets. And let's be conscious about how much equities have rallied since their October lows, and also how bonds have rallied, in particular yields dropping back to the 4% level. So I think the markets at the moment should be consolidating and thinking about, what are going to be the major events in 2024. And I will go back to the bond market. There was an interesting comment from Bill Gross the other day, of ex-PIMCO, highlighting that bonds are overvalued at 4%. And I do think that one of the potential catalysts for a correction would be people saying, okay, the US economy is going to continue to grow this year. We're probably not going to get rate cuts in the first half, and that it doesn't make sense that the yield curve is so inverted at this point in time. So I think investors should be conscious about that, but it's against a backdrop of what I suspect is still going to be another good year of economic growth.
Adrian, hi, good morning, and season's greetings to you. When we started the year, at least the narrative was extremely positive all along. I mean, we were looking at rate cuts in the US, possibly a soft landing, and, continued momentum in the economy here in India. Do you also see it that positively? Because in terms of price action, markets are obviously, they have, a lot to question as the year rolls out. Are we looking at pretty much this perfect setup? Or, is there perhaps a risk element that markets have ignored?
So I think there's a conflict between, phrases like soft landing and the Fed cutting early. I'd rather say that, look, the US economy is not landing. It's going to continue to expand, maybe not as robustly as it was in 2023. And if that's the case, the pressure on the Fed to cut rates is quite moderate. And bond investors need to reflect on how extremely inverted the yield curve is. So this, to me, is really the threat that causes a correction in markets. But I view it very much as a correction in a bull market rather than the start of a bear market. So go back to it. If you believe in a soft landing, which is that the US economy doesn't go into recession, then the yield curve should not be inverted.
So in terms of, just to, follow up on that, what would be a realistic expectation from the Fed? The Fed said 3 cuts this year. I think markets in December jumped with joy, expecting 6. And now there's some reality, pricing that's happening. What would you reckon would be perhaps a base case for this year in terms of rate cuts that would keep the market happy?
Yeah, so maybe we finish the year between 4.75% and 5% on Fed funds rates, with the cuts being very much back-ended. So follow the dots from the FOMC committee meeting, not the over-exuberant futures market.
Hi, Adrian. Morning. Good to see you. And Nigel on this side. Well, how do you approach a market like India? We have been rank outperformers, plenty of positivity with regard, to leadership at the helm. We also have a decent amount of flows that came in the past 1 month or so. But at current valuations, what would your approach be to an emerging market like India, which, mind you, offers very, very good earnings growth, but valuations could be a hurdle?
So the story of 2023 was to run your winners. And India was the winner within emerging markets. Now, it's cause positioning that is very favorable towards India. So if you look at the ETF flows, the flows into net flows into Indian ETFs, are much greater than the flows into any other emerging markets. And some of the major emerging markets like China have seen outflows. So I think valuations and positioning, continue to be a negative for India. So if I look at the MSCI forward PE, it's just below 22 at this point. That said, the Indian economy is definitely a winner within the emerging market space. You've got the highest level of economic growth. You've got, an inflation dynamic that is manageable, the potential for slightly lower rates. I don't think that the election this year is a big event for capital markets. The assumption is a continuation of the current government. So I think it's still a story of run your winners for now. I think if India was to see a period of underperformance in EM, it would really have to be a dynamic that something happens in China that breaks this very protracted bear market. Now, clearly, if that event was to occur, then it would put quite extreme pressure on EM funds that are very underweight China and overweight India. Sadly, at the moment, I'm struggling to find a reason to turn aggressively bullish on China.
The prices down and out, not reason enough, right? You need more in that sense. Just one thing. For the Indian metals space, which is a global it's globally exposed cyclical space, and China is a big mover there. Do you think hope still lives, especially for commodities like copper, etc.? China will try and do more, right, to stimulate. And one of the channels through which it feeds in is copper. And I mentioned specifically copper because there is also the renewables transition story, etc. Any thoughts at all for commodities as a space?
So just an observation, China's putting in place public sector stimulus because the private sector is weak. And the real focus of that is the property sector. Now, you've got another help in the property sector for now from the government. So the government's been very concerned about social unrest because property developers have taken money from households and they haven't delivered the apartment. So their real focus is to get those apartments finished and delivered to those that have paid for them. And that temporarily, I think, is holding up commodity prices. If you look at the market, it was down a week again in Hong Kong. It was due to very, very weak property sales. So I think that people are a little bit too complacent about Chinese commodity demand. It's because the property developers at the moment are delivering those units. They're using the commodities, including copper, but they're not making new sales. And I think you're going to, trade into a vacuum of demand at some point this year. And that will obviously hit iron ore more dramatically than copper, because as you highlight with energy transitions, there are many other uses for copper. And also the copper price has really been too low in the last couple of years to encourage meaningful new capacity to come on stream. So I would favor copper over other commodities, but I would imagine that if you do get a China-driven correction in commodities, then the whole complex sells off and you look to add to copper at that point. But I would be very cautious about commodity demand, and it's back to the whole dynamics of the Chinese property market.
So complete opposite to what we're witnessing here in India, Adrian, where all of these premium plush houses in Gurgaon and Mumbai, they're flying off the shelves even before the launch period is over. Pre-launch days, apartments get sold out in like 2-3 days flat. Which brings me back to the question, what do you see as the big trade in India? Will it continue to be what we saw in 23, which is PSU stocks and industrials and capex? Could it be something different? People are waiting for the big Indian banks to take off in a meaningful manner, but we're yet to see a consistent move there. What's your bet?
Yeah, it was interesting. The financials trade was very weak in India towards the end of the year relative to what we were seeing in European and US equity markets, where there was quite a strong rally in the major banks. My bias would be to be in the banks as an overweight position as an underperformer. And the underperforming the underperformance of the banks, I don't think was necessarily justified by the fundamentals and the earnings growth.
Okay, all right, Adrian. Final question before we let you go, since we just briefly spoken about banks. What about tech? You know, you have the IT earnings that kickstart tomorrow here in India, and that's the other pillar of our markets. What's your view? Because the global markets, global economies itself could be in a bit of a flux, but some of these stocks are still holding closer to the higher end.
Yeah, I still think the tech story is one you want to be long in a global portfolio. And, you know, within India, the Indian tech companies have underperformed global tech quite meaningfully, and I think look attractive within the global context, whether that's an all country or just an EM portfolio.
Got that, Adrian. Thank you very much for you know, sort of that detailed picture of what you make on global macros more than anything else, and of course a bit of individual markets as well. That's Adrian Mowat, long-term investor, emerging market sort of analyst, investor, and who's watched India pretty closely as well.